Hello, my friends, and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about everything related to transforming the global business and investment communities to create wealth on an ongoing basis in ways that enhance societal well-being. So I've done, I don't know, about probably close to a dozen episodes at the moment. Please subscribe to my YouTube channel. Just go onto YouTube, search for Valuation Insights. That's my private company name. And the podcast series is called Transforming Business. And there's a playlist so you can kind of follow along with me as I go through the journey with you. There's so much to talk about. There are so many nuances behind the work that I'm doing to transform the global business and investment communities that I've just found that it's way easier for people to consume these ideas in little bite-sized chunks in a video format, because as far as I can tell, a lot of people just aren't really interested in reading that much these days, and particularly people in a position of influence in the business and investment communities. They are so time poor that about the best way I can outreach to these people so that they can get on board with this is in these smaller video clips. So today's episode, which I'm very excited about, I'd like to describe to you a series of unique digital assets that I have that I've developed and prototyped, and that I'm looking to scale up and commercialize in a sort of large-scale data environment, supporting ongoing wealth creation and the transformation of companies in the investment communities for ongoing wealth creation, but particularly in ways that enhance the well-being of societal well-being. So, but before I do describe those digital assets, I do need to recap a little bit and talk about some concepts and metrics and measurement around wealth creation, because at least one of the digital assets that I'm going to be describing today is 100% underpinned by a series of pretty clever corporate finance metrics around wealth creation and the determinants of wealth creation. So we do need to just take a little bit of a journey. And what I will say to the listener is have a look at some of the previous episodes, because I have described these concepts previously, but I'm just going to do a quick recap, and the recap is going to be fairly fast. So please stay with me. But if you want to delve into more detail, by all means, have a look at some of the earlier videos. And if you want to delve into more detail again, by all means, please get in contact with me. I'm happy to schedule a briefing for your board, your executive team around these very important concepts. So let's get into it. All right, let's share some screens, and here we go. All right. It makes sense to start from the beginning and define what wealth creation is, because a lot of people talk generically about wealth creation, but I suspect the vast majority of people don't really have a full definition of what wealth creation is, how you measure it, and then, of course, how to create it, which is, the measurement side is important. And one of the digital assets is all about measuring wealth creation. So let's define it. So wealth creation is when the total equity return, which is a whole of company concept similar to total shareholder return, right? So TSR is on a per share basis. Total equity return is on a whole of company basis. It is important that you think about things from a whole of company basis, but let's define it. Wealth creation is when the total equity return over any measurement period is greater than the cost of equity at the beginning of that measurement period. And so on the right-hand side of this chart, let me get my pointer up. Just bear with me for 1 second. Okay, so on the right-hand side of this chart, in the orange line, I'm plotting wealth creation as measured from a percentage measurement, total equity return less the cost of equity, on a 1-year measurement period. And then, of course, I'm in the dotted line. There's a line of best polynomial line of best fit flowing through it. So this is for the an aggregate of the top 50 non-resource, non-financial services companies listed on the Australian Stock Exchange over the 20-year period from 2000 to 2020. And I've constructed this, this metric of wealth creation. So that's how wealth creation is defined. It's when the total equity return is either greater than, equal to, or less than the cost of equity. That is the benchmark. A couple of important things to note about this. Capital markets are incredibly volatile, and that's problematic. And the other thing to observe just from this chart is that it's very difficult for any particular company, let alone an aggregate of, an index of companies or a portfolio of companies, to create wealth, in other words, be north of the zero line on an ongoing, consistent basis. And this is for a couple of reasons. One is, as we observe share prices and market caps in the capital markets, because they are largely operating on a basis that's devoid of any sort of fundamentals, then there's going to be a lot of overshooting and undershooting of share prices relative to intrinsic or fundamental value. And that's problematic. And so that's one reason why the wealth creation time series is so volatile. But the other is that it is incredibly difficult to create wealth in a sustainable, fundamental way on an ongoing basis. And I've talked about that in a previous episode. So that's defining wealth creation in a fundamental sense. And when I say fundamental sense, I mean if capital markets were to price shares of companies consistent with intrinsic value at all points in time, then wealth creation occurs when the market value of the company over a measurement period, or at the end of a measurement period, is greater than that which was expected at the beginning of the measurement period. All right. So that's defining wealth creation in a different way. And so in a fundamental sense, what I'm interested in, and what I think institutional investors are interested in, is what is the board and what is the executive team doing within the company to cause its fundamental or intrinsic value over a measurement period to be greater than that which was expected. And they do these by a deliberate combination of strategy, investment, tactical initiatives. In another way of saying this is that the board and the executive team are going about their business to make the value of the company increasingly higher by doing good things. And so, so that's a fundamental definition of wealth creation. Now, it's really important, and I'm always really interested in wealth creation on an ongoing basis, all right? So it's one thing to put in place a deliberate combination of strategic, growth, operational, and tactical actions here over a 2-year measurement period that creates wealth, right? So it's one thing to do that. But more importantly, institutional shareholders are interested in this happening within companies on an ongoing basis. So not just once, but again and again and again. And so the ongoing nature of this implies that there is an ongoing series of a deliberate combination of strategic, growth, operational, and tactical actions occurring within the company all the time, year and period after period after period. And this is why it's so difficult for companies. And this is why there's a whole transformation and a set of capabilities that I'd like to bring, and with a group of people, bring to the corporate, and the investment communities. And it's all of this intellectual property, understanding, insights, capabilities that is going to underpin and drive the transformation effort that I'm working towards, along with others, on a global basis. All right, we need to then just think about some apex metrics, the first of which is the concept known as economic profit and economic profitability. These metrics are apex measures of financial performance, so the performance that companies derive from their financial accounts, so the P&L on the balance sheet. But the really important thing is it's not profit that people or companies and profit maximization that companies should be focusing on. It's deriving and generating an ongoing series of positive economic profits. And economic profit is a measure of apex measure of performance, company performance, that includes a charge for the capital employed to deliver an accounting profit outcome. And so there's a couple of important metrics: economic profitability, which is the percentage measure, and then economic profit, which is the dollar measure. And economic profitability is return on equity less the cost of equity. And to construct these metrics, you need a combination of the P&L and balance sheet for companies. The next thing that's really important is understanding how the value, the intrinsic value of a company can be measured in economic profit terms. And I've talked about this before. I've used this slide before. So if you're interested in the fundamentals of business valuation, have a look at that podcast episode from about a month and a half ago. But increasingly, what I'm moving towards is reflecting an intrinsic valuation in economic profit terms, so forecasting an economic profit stream that is linked to a shift or a change in strategy. And so on the left-hand side here, there is a strategic position assessment framework that can be sort of used to understand the economic profit potential of the company as a result of adopting or a change in strategy. And that forecast of economic profit, when discounted at the cost of equity, will give you a measure of intrinsic value, and that intrinsic value gets compared to the book value of equity, and the difference, which is the present value of the economic profit stream, is the value created. So really important metrics. One of the other important metrics that get derived from this is a metric called the market to book ratio. So it's a ratio of the intrinsic value, and it can even be the observed market cap on the numerator and the book value of equity on the denominator. So the market to book ratio is a fundamentally important metric, and it is linked to the economic profit stream required to be delivered in order to justify a valuation outcome. All right. And so the fundamentals of an economic profit valuation has three primary drivers or dimensions. The first is a forecast of economic returns, so economic profitability linked to strategy. So what is a realistic or an objective assessment of economic profitability given the strategy over a forecast horizon? And then the really important thing is that in order to ground the valuation in fundamental realities or economic realities, the safest assumption to adopt in a valuation approach is that the forces of competition, so in other words, if left unattended, so if that strategy is left unattended after the end of a forecast horizon, here I've got 10 years. So when and if left unattended, the forces of competition will drive those returns down to zero and drive growth, the growth in equity, back down to sustainable growth in equity. So the drivers are a forecast of returns, a forecast of growth, and then the third dimension is the length of this convergence horizon. How long will it take for the market forces or the forces of competition to drive returns and growth back down to sustainable levels? And the length of the conversion horizon, by the way, is linked to the strength of the strategy, the extent to which the strategy has a unique set of strategic advantage that can hold back the forces of competition for longer periods of time. So strategies that are very compelling will have long convergence horizons. Strategies which are less differentiated, less strategic advantage will have short convergence horizons. And all of these things impact on the intrinsic value of the company. This is the fundamentals of business valuation, well beyond PE ratios, comparables, and a lot of other valuation methods used by, frankly, thousands and thousands of valuation professionals out there. It really is time for an upgrade. Okay. The other important thing to realize then is that we can use the fundamentals of an economic profit valuation approach to reverse engineer the economic profit expectations embedded in a share price at a point in time. And so what I'm showing on this chart is the EP expectations embedded in the share price of an Australian company, a biotech company called CSL Limited, as at 30th of June 2020. So let me just quickly describe this. Again, this is just a recap. So the market cap of CSL as at that valuation date was about $130 billion. Now that's large for the Australian context. It's not so large in the US. Obviously, there are close to $1 trillion companies in the US, various US markets. But in the Australian context, this is one of the largest market cap companies out there. So $130 trillion is the market cap. Now, the interesting thing is that only about, $130 billion. The amount of capital invested in CSL, so the equity injected in CSL and retained earnings, in other words, profits not redistributed, is only about $7.9 billion. So what we have here is an incredibly large market to book ratio, and therefore an incredibly large $122 billion of value created, or market value in excess of book value. That's what that value created metric means. Now, in order to justify such a large market to book ratio and such a large value created amount, the market must be expecting, if it's pricing these shares in accordance with fundamental business valuation, good old-fashioned business valuation principles, the market must be expecting CSL to deliver an economic profit stream which is, frankly, orders of magnitude, and maybe not an order, but multiples of what it's been able to deliver in the past. So here is the historical economic profit delivered by CSL over a 10-year period from 2010 to 2020. But in order to justify the share price of CSL in 2020, it then needs to deliver a massive step up, a massive growth in economic profit over the next 10 years, and then continue to do that until the forces of competition, through a combination of returns and growth, finally turn the apex of the EP horizon before the forces of competition drive economic profit to zero over a 50-year convergence horizon. Now, 50 years is an incredibly long convergence horizon. I personally don't believe that CSL can, under the current strategy right now, 50-year convergence horizon is incredibly long. But in order to make the numbers may have any meaning, I've taken the longest convergence horizon that is practically meaningful, and that's 50 years. So the point about this slide is that an EP valuation technique can be used to reverse engineer through an EP horizon the EP expectations that are embedded within a share price of any company at any listed company at any point in time. All right, so that's really important. Previously, I've introduced you then to the concept of a pair of EP horizons, and let me just quickly describe it to you again. Because these pair of EP horizons have a fundamental link to wealth, the notion of wealth creation as well. And this is part of the unique intellectual property that I'm bringing to the table here, and that will be embedded in these digital assets. All right, so as a quick recap, let's replay this. Imagine that I construct an EP horizon for a company in 2015, so sometime in the history, 5 years ago. And so in 2015, this orange line here represents the EP horizon required to be delivered in order to justify the share price back in 2015. And then what I do is I construct a second EP horizon 5 years later. So in 2020, this blue line, so starting from here, this blue line is the EP horizon required to be delivered in order to justify the share price in 2020, okay? So I've got two EP horizons. And what I then do is I fill these two curves together by reflecting the economic profit that was delivered over the 5-year measurement period. Now, there's really important things or ideas that come out of it. So wealth creation is really the present value impact of the areas between these two curves, all right? And I can break it down into two parts. The area of the curve that over the measurement period. So this is the EP that was expected to be delivered over 5 years from 2015 to 2020, and this is the EP that was delivered. And so the EP that was delivered was less than that was required to be delivered. So that's this red area here representing a component of wealth destruction. All right. But, and the interesting thing is that from 2020 onwards, the market now expects this company to deliver an EP stream higher than what was expected 5 years ago. And so this represents an area, if you like, of positive contribution to wealth creation. And so the total wealth creation in dollar terms is the sum of these two bits. But there's a lot of really smart mathematics and corporate finance that is required to make this technology work and these metrics work. But they are very important concepts. There are two components to wealth creation: what occurred over the measurement period and what is required beyond the measurement period. And the important thing that I'll give you the answer straight up. It is way more important to focus on the long term. So put in place strategies that drive this green area. So these are performance outcomes to be delivered into the future is way more important than what happens over a particular measurement period. And the unfortunate reality is that so many boards, so many executives, and so many fund managers and investment analysts, equities analysts, are so focused on the short-term history that they're really missing out on the fundamental drivers of wealth creation, which is putting in place the strategies and the capabilities to drive performance outcomes into the future. That's the important thing. What happened in the past is relevant, but in terms of wealth creation, this area here, which is what's required to be delivered in the future, far outweighs and dominates any positive or negative wealth creation consequence over any 1, 3, 5, or even 10-year measurement horizon. Okay, so one of the fundamental principles of ongoing wealth creation is to take a long-term view, looking to the future. It's all about the future. All right. So if you're spending too much of your time mired in the past, you're going about things the wrong way. Trust me. Okay, and so here is a construction of a pair of EP horizons for CSL, the biotech company that I described earlier. And so what that's showing again here is the orange curve, which was the EP expectations in 2010, which was kind of 10 years ago from 2020, and then that which was delivered over the 10-year period, and then the EP horizon required to justify the share price in 2020. So, straight up, for a successful company like CSL, the area of between the two curves beyond the measurement period is far, 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 far greater than the area of the curve over the measurement, between the two curves over the measurement period. All right. So I'd like to now introduce you to the first of a series of digital assets. And the first digital asset I'm calling the CAUSE Wealth Measurement Platform. So this is all about measuring wealth creation outcomes. And the term CAUSE, I've introduced it before, is an acronym that stands for Commerce Acting to Uplift Society. That's the CAUS bit, and the E is exponentially, which means that these cause outcomes need to come from exponential thinking, not linear thinking. So that's the term that underpins the CAUSE initiative. All right, so the CAUSE Wealth Measurement Platform has 3 modules. I should say that this has been fully prototyped and is ready to be rolled out and commercialized. And this platform will sit along, Bloomberg terminals, Refinitiv, FactSet, Morningstar. So these are, if you're familiar with Bloomberg, Refinitiv, FactSet, Morningstar, and possibly if you have one of these data terminals on your desk, then this is an adjunct to that. And so whereas the Bloomberg's, Refinitiv, FactSets, they have a plethora of metrics that are unrelated and whatever, but the CAUSE Wealth Measurement Platform will have a variety of metrics that are 100% geared to measuring wealth creation and providing insights and into wealth creation. So this platform will extract and load in a series of capital market and financial data, and presumably sourced from a Bloomberg or Refinitiv, a FactSet, a Morningstar. And Morningstar is actually an interesting data provider and a partner for this, by the way, and I'm going to come to that later, because Morningstar owns Sustainalytics, and Sustainalytics has a role to play as well. So we load data, source data in. It is curated. We do a bunch of calculations which are unique to the CAUSE initiative. There is not another person or group on the platform that has the calculation technology to underpin all of this stuff. And of course, there's going to be graphical, outputs and graphical user interface, and a whole user interaction profile. Okay, so at this point, this is kind of fairly standard. I load some data in, I curate it, which means I fix it up and get it all ready. I do a bunch of calculations on it, and imagine that all of this is taking place for 20, 30, 40,000 listed companies worldwide, right? So in 50 to 100 capital markets. So we've got a very large scale database. All right. So I'm going to describe I'm going to describe in some detail two specific modules. So the first module is presenting historical economic performance outcomes from this data set. And so there's going to be a longitudinal view of capital market metrics and then financial performance metrics. And again, think about this as when I say longitudinal, I mean a long time series, at least 20 years, so the longer the time series and the more companies included in the data set, the more insights and comparing and aggregating that you can do. And so think about this CAUSE wealth measurement platform as being a data platform, a financial data platform from which you can compare anything against anything else over any time period. So we can look at a particular company and we can aggregate companies together and create portfolios and compare and contrast over any time period. So let's have a look at some of the metrics and longitudinal views from the capital market performance metrics and capital market performance. And this is just gearing around observed capital market metrics, so share price type metrics. So for any particular company or any aggregation of companies, there are a series of apex capital market wealth creation metrics that we can plot over any time period. And so here I've got a long time series of wealth creation or absolute wealth creation, which is TER less the cost of equity, over a series of time measurement periods. So the yellow line here is a 1 year measurement period, and you're going to notice that this kind of bounces around a lot. The green line here is a rolling time series of wealth creation over a 3 year measurement period. The blue line is over a 5-year measurement period, and this dark black line here is over a 10-year measurement period. And so in these time series, you can construct from basic capital market metrics with some smart corporate finance calculation, total equity return, absolute wealth creation, which is TER less the cost of equity, risk-adjusted wealth creation, which is a term that I've constructed called TER alpha. I'm not going to get into the details of TER alpha, but it is very, very relevant for anyone that's in the investment space. And then market to book ratio is another really important time series metric that matters. So that's and of course, when you've got a large database of tens of thousands of companies over a long time, longitudinal time horizon, and you can aggregate and compare and contrast, you can imagine how many the kinds of insights and outputs you can get from that. So I want to then quickly look at the historical database for company financial performance. And so these are the kinds of metrics that can be derived from companies' regular published, financial accounts. So, annual reports, half-year reports, even quarterly reports. So the apex metric is economic profitability, and the contributing metrics are return on equity, cost of equity, and then a series of other performance metrics like return on asset and the equity multiplier, and sort of going back down to as many layers as which we can derive standardized numerical outcomes from the P&L and the balance sheet. So we can go back as many layers here as we can construct standardized metrics that mean the same thing for all companies within an industry, within the database. And so here what I'm showing is a economic profitability DuPont, and I'm showing a company, an Australian industrial company called BlueScope Steel in the top right, and comparing it to the aggregate of the top 50 industrial companies over a 5-year measurement period to 2020. So you can imagine all of the underlying input data and all the calculations required just to produce this chart, where you can compare economic profit performance for any company against any other company or an aggregate of companies over any particular time period. And then, of course, we can then plot a time series of economic profitability over a 1-year, 3-year, 5-year, 10-year, whatever you want. I mean, the data is all there over a longitudinal period. And so what we're showing here is the aggregate of the 50 industrial companies in Australia. And so the interesting thing about this is that in the lead up, in the boom period, in the lead up to the global financial crisis in 2008, industrial companies in Australia were quite economically profitable. They were doing really well, and it was primarily driven by a resource boom, and then the flow through effects of a resource boom. But then post the GFC, and I'm following along the yellow lines at the moment, which is the 1-year measurement period. There was a period of very choppy economic profit performance, negative economic profit performance, and it's only in the last couple of years leading up to 2020 that we're starting to reverse a fairly long period of negative economic profitability. And more recently, we're in a downturn, and I don't have the data in front of me post-COVID, but so that's kind of, it's really helpful to understand long-run time series economic profitability performance from an internal company's perspective, because the strategy objective is to be economically profitable by creating strategic advantage, but increasingly it is about doing things that enhance societal well-being. All right. Of course, then I can create a series of bar charts on the left-hand side. I'm comparing the economic profitability of industry sectors, and so pretty much all of the industry sectors in the Australian stock market. And biotechs, and technology companies are very economically profitable. Here is the average of the industrials. It's slightly negative over a 5-year measurement period to 2020, and there are a bunch of industries that, for a long period of time, have been negative economic profitability. So certain industries have certain levels of ingrained innate economic profitability. But then let's delve into the industrials, and on the right-hand side, I'm showing all of the industrial companies. And again, there are some companies that are more economically profitable than the average, and some industrial companies that are less economically profitable than the average. And here's our friend BlueScope Steel, which I was profiling a little bit earlier. They're just a little bit more economically profitable than the average, but certainly not the best in the industry sector. So anyone who's an equities analyst or a corporate strategy person really needs to know this. And so this database, if you've got a data terminal in front of you, anyone that's doing investment, corporate strategy, anyone that's an equities analyst really does need to have this database in front of them. Okay. I then want to start talking a little bit about the benefits, advantages, and insights that come when we construct EP horizons from share prices. And again, imagine 20, 30, 40,000 companies doing this, recalculating these EP horizons on, let's say, a weekly basis. So you can get a sense of the volume of data and the kind of metrics and insights that sits behind the CAUSE wealth management platform. So let's have a little bit of a dig in. So of course, the first thing is we can construct an EP horizon for any company at any point in time. And here I'm showing CSL again as at 30 June 2020. And there's a fairly clever set of technology that allows me to construct these EP horizons in an automated way. So, with a small amount of source data, I can create a lot of supplementary data, which creates a lot of insights. Then, of course, if I can do it for one company at one point in time, I can do it for all companies over any point of time. And so here I'm showing a progression of economic profit horizons. Again, this is for CSL over various periods of time. And so the interesting thing about when you observe these progressions is some companies, so basically what's going on here is that as we move forward in time, the EP expectations as we move forward in time are getting higher and higher and higher. And that's a great indicator of ongoing wealth creation, at least as it's represented in the share price. But a lot of companies have, very high EP expectations, and then a little bit later, it's much lower. And so they're creating wealth over a short measurement period, and then they destroy a lot of wealth because the share price is just bouncing around. Now, if you're an equities investor, or an institutional investor or a fund manager, you want to know where the EP horizon is and how it compares, over time as you're making your investment decisions. So it's kind of really important information. Of course, we can then construct a pair of these EP horizons. This is again is CSL. We've seen this before over a measurement period. And then from this, and I'm not going to go into detail on this slide, but there is a wealth of really important metrics that get derived from constructing a pair of these EP bow waves. And anyone that's interested in the detail of these metrics, please get in contact with me. I'm happy to schedule a briefing on this stuff because it's really important. Now, one of the other things you can then do if you've got a progression of these EP horizons is construct this chart. So what this is showing is the blue line here is the economic profitability required to be delivered to justify the share price at various points in time, right? So in 2001, it's a longitudinal time series of all of the economic profit expectations that need to be delivered over the next 10 years over a long period of time. That's the blue line. And then compare that to the average economic profitability actually delivered by this company over a 3-year average. And so we line up these two curves, and this is CSL. And so what we're seeing here is that the market is expecting CSL to deliver a level of economic profitability, which for a very long period of time has run well ahead of what it has actually managed to deliver, at any particular point in time. And so the gap between the expectation and the delivered can be filled in a number of ways, right? So one way is that the company actually has a strategy in place that the market is, recognizing, where the expectation is legitimately higher than the average that's been delivered for example, the last 3 years. The other possibility is that the capital markets are reflecting a value of this company in excess of what it's able to deliver. And as an equities analyst and an equities investor, when you're making your investment decisions to either buy, sell, or hold either a particular company or a portfolio of companies, implicitly, you want to be answering the question in your own mind, if there is a large gap, does the company have the capabilities, the strategy, the transformation agenda in place to fill that gap? Because if not, you might want to think about rebalancing away from this company and start looking for better investment opportunities. Okay. The last aspect, which I don't have any slides for, but you can just imagine it, is a user-defined valuation utility that hangs off this, this wealth measurement platform, where equities analysts use the user interface and the framework and the structure to forecast economic profit growth and convergence horizon metrics to perform intrinsic valuations. And so can you imagine if there are thousands and thousands of equities analysts around the world valuing companies, putting their forecasts into this measurement platform, making those available on a subscription basis to the investment communities and to corporates, and then being able to compare analysts' forecasts at various points in time with actual performance, then we've got a really powerful financial market database and the metrics and the measurement platform that really underpins ongoing wealth creation in ways that enhance societal well-being. So that's that platform. The next digital asset that I'd like to talk about is the CAUSE-OCI assessment matrix. And I've introduced this a number of times before. If you haven't seen it yet, have a look at some previous videos. But it is making an assessment of, again, 20, 30, 40,000 companies around the world at various points in time on two dimensions. So a CAUSE rating, which is an objective assessment as to the extent to which the organization is operating in ways that are either consistent or inconsistent with CAUSE initiative principles. So this is all about enhancing the creating wealth on an ongoing basis, and this dimension is all about in ways that enhance the well-being of the individual, the wider community, and the environment. The horizontal axis is the organizational capability index rating, and it is an objective assessment as to internal capabilities within organizations to allow them to create wealth on an ongoing basis, and particularly dealing with things or dimensions like board governance, strategic management, operational effectiveness. There's a big thing to say about culture and leadership. And at the end of the day, ongoing wealth creation is all about harnessing and institutionalizing innovation and creativity. So though both of those dimensions are critically important, and so the objective here is to scale up an assessment structure, which I've got in prototype, but scale it up so we can objectively assess where thousands and thousands of companies around the world sit on this matrix at various points in time using a standardized assessment framework and scales and so on. Now, I mentioned Morningstar as a likely candidate because they have recently acquired a firm called Sustainalytics, who may well be a candidate to putting in place the resources to assess companies on this framework put the metrics in a data set and make those available for the investment community and the corporate community, because boards and executives, they need to know where they sit on this assessment matrix. Institutional investors, fund managers need to know where companies sit, but more importantly, they need to know and assess whether companies have an aspiration to move from a disadvantaged position into the top right quadrant, because the transformation that we're talking about is getting companies out of the bottom left, which my assessment is the vast majority of corporates around the world probably sit in the bottom left, and that there is a significant amount of transformation effort required to move towards the top right. And so can you imagine if there is and Sustainalytics and various others do all sorts of ESG kind of assessment or rankings and ratings, and that's fine. But what I'm talking about here is well beyond the standard, ESG metrics. And about where ESG fits into this is that some ESG metrics that Sustainalytics and others currently measure may be inputs into assessing the vertical dimension of the CAUSE-OCI assessment matrix. But this assessment framework and matrix goes well beyond just piecemeal standardized ESG metrics. All right, so that's and so the call to action here is that I'd like to be able to scale up and fund and then make available to a large global user base on a subscription basis this kind of assessment data set. It will be really, really powerful and really important. The last digital asset that I'd like to talk about, and I'm going to do this very briefly, is a set of a digital asset that helps companies basically operationalize at least these three aspects of ongoing wealth creation. So that is being able to measure the value of the company, the intrinsic value of the company at a disaggregated level at any point in time, to put together strategies and then value those strategies with the objective of creating wealth, and then wrapping around that a series of strategic management structures that operationalize strategic management with the goal of ongoing wealth creation. There's a prototype of each one of the elements of this, and so again, if someone is willing to partner with me to build out this firm, this capability, this digital asset, it will be really helpful for corporates to have a strategic management platform built around and incorporating all of the unique intellectual property, insights, and capabilities that has been developed around the CAUSE initiative over the last sort of 7 to 10 years. Okay, that is a fairly comprehensive run through a series of digital assets. Thanks for tuning in. Please like, share, subscribe to my YouTube channel, and get in contact with me if you have any questions about some of these things, and particularly if you're in a position of influence to help me build these out and commercialize these digital assets so that they can underpin the transformation effort, which is where pretty much everyone is, at the end of the day, interested in. Thanks for tuning in, and bye for now.